With the flurry of IPOs happening as this year comes to a close, you might be asking, what exactly is an IPO and why are they such a big deal? IPO stands for Initial Public Offering. It is the first sale of a company's stock on a publicly traded marketplace. Going through an IPO turns a private company into a public one. Private companies are usually owned by a small number of investors, such as angel investors or venture capitalists. Going public allows anyone to access and own shares of a company. Why would a company want to go public? First, it can be a big payday for founders. A company's value will often increase when it goes public, leading to a corresponding increase in the value for each owner's share of that company. Being a public company means listing on a stock exchange where shares are much easier to buy and sell to other people. This gives founders or early investors who may own valuable stock but are unable to sell this stock for cash as easily in the private markets a way to finally cash in on their investments and hard work. Third, the immediate sale of new shares on the exchange allows a company to access more capital for investing in hiring new products or expanding the company. Lastly, there is prestige in being a public company, and this appeals to many founders. So, how does an IPO work? Well, in a traditional IPO, the company finds an underwriting firm, usually an investment bank or two, which funds the IPO initially, guaranteeing to buy the shares before they are even listed. The investment bank works with the listing company to determine the number of shares to sell, what price to sell at, and when to actually sell. Additionally, the investment bank registers the listing company with the U.S. Securities and Exchange Commission, or SEC. The investment bank then tries to sell the shares they purchased from the listing company to institutional investors for a higher price than the bank paid. This pre-sale of company shares to institutional investors is called the roadshow. IPOs are also exciting for everyday investors who can buy shares of newly listed companies which may grow to be big companies in the future. Imagine buying some shares of a small company called Amazon back when it was still a startup. IPOs are also great for employees who have stock options or partially stock-based compensation. It allows them to realize the value of those shares and sell them to others to cash out. Lastly, IPOs are also when most early investors in a company will finally cash out their investments.